Welcome to the fifth episode of Dividend Discussion here on Dividend Obsession. With this new series, one of my goals is to share my passion for passive income through dividend investing with others. During these interviews, you're going to hear the story of someone else doing dividends their own way. Hopefully, you, the viewer, can take something out of each and every one of these interviews to make yourself a better dividend investor. For my fifth guest, please join me in welcoming Dave. He was born in Australia, now lives in Thailand, and has a ton of investing wisdom and stories that apply to investors across the world. In this episode, we discuss things like what it was like to invest back in the day, determining when to sell, and the importance of tracking progress and having goals, and much more. But without further delay, please enjoy the show. Hello, everybody, and welcome back to Dividend Discussion. I'm here today in this episode with my friend Dave. Dave, if you wouldn't mind giving yourself a brief introduction and telling us what got you into dividend investing and when you got started.
Yes, no problem. So I'm Dave, and originally from Australia. I'm residing in Thailand now, but I can well remember my interest in pure dividends because I had a holding in Rio Tinto in 1998. I still have the holding, by the way, and this is where I always argue that dividends are important because for me this was a catalyst. Even though obviously I was 25 years odd younger, I got a paper check for $200 and something AUD, not US, but to me that made everything tangible. And when I actually got that paper check and went down, I thought, $220 25 odd years ago, it was a lot of money. And I thought, well, I've gotten this for, back then I would have said to myself, doing nothing, because I could only ever collate selling labour for money. And that was kind of what fired me up to think, hang on, there's something in this, and there's something I can potentially create.
That's really cool. So in your opinion, so I know back in the day, they used to actually give paper checks for the dividends because they didn't do the actual, here's just money in your account. Do you think that would have impacted you differently by only getting the electronic funds instead of the paper check, or wouldn't it matter?
I don't think it would have mattered that much, because I think I would have still seen it, but there was something about getting that check, and this is what I always say to younger people, because at the end of the day, I still wasn't that young when I got that, and I've still done okay. So if I was starting at 25, it'd be even better. But, to think that paper check, and I collated the paper check back to the days when I was working various relatively poorly paid jobs and thinking, shit, this was a week's pay or something like that.
Yeah.
So really, I don't think it would have mattered if it was electronic transfer, but that wasn't available in those days. It was just was what it was, and that was kind of my moment. I remember getting into the car and putting that in the glove box and thinking, wow,
Yeah,
that's really cool.
That's super cool. Yeah, I remember. I don't remember, but I've heard and I've read that you used to actually get paper copies of shares that people would put in the boxes at the safe, or the safe deposit boxes at the bank. So if you had a share of Coca-Cola, you'd get a paper that said you owned one share of Coca-Cola. All kinds of stuff like that. So that'd be pretty cool.
A holding statement kind of thing. I mean, we still get those. I'm talking ASX, right? So I know most people here will be USA, but I'm talking ASX. And yeah, it's to a degree important, but nothing like what it was, because you have this actual document.
Yeah.
Here's what I'm holding in Coca-Cola or whatever it was. And so very different.
That's pretty cool. Okay, so with that being said, did you begin your investing journey with that Rio investment, or did you start your investing journey before that doing something different?
No, I went right back to prior to the crash of '87.
Okay.
Before you were born.
Yeah.
And what had happened, I didn't know anything about anything. Pretty much, I was just a kid. But I'd gone. My family was into investing, and I had my father in particular. So I thought, I need to get these shares, but I didn't know how. Or back then, you had to call up a broker and all this kind of stuff. And I went to this guy, who's a very wealthy man today, but he was a little bit younger than me. And I said, I want to buy some shares. I want to buy some equities. And he said, how much have you got? And I was about 23, I think. I said, I've got $1,000. You know, he said, well, you know, there's no point with $1,000 even back then. There's no point you buying, you know, I'd buy something like this. And he picked out one particular share. And you got to remember, ASX is a lot smaller than USA and all that sort of thing. But it was a penny dreadful, so to speak. So I just said, yeah, no, terrific. And I remember I bought this, it was called Australian Developments. It was a miner. And I bought this thing for 18 cents. And I put a couple of other people into this. I said, oh, no, this, you know, it was just all BS when I think about it, how I went about it. There was no tangible evidence to support my selection. But now I know I was gambling, but I didn't know that then because I thought, no, I'm a shareholder in this company. Well, everybody else sold off because the thing went from 18 down to 14, and then, you know, went back up to what I paid 18 and went back up to 20, and then all of a sudden doubled to 40, and then it went to 60. So I'd made more than 3 times my money on my first ever thing. Now, to put it in perspective, my 1,000 was now 3,000 and a bit. I sold. I rang up the broker. I sold because I bought a unit in a suburb called Cheltenham for 46,500. Now, if you think about it like that, 3,150, whatever it was, I was heading towards, you know, a decent deposit purely on this thing, and then I had another $20,000, and so I owned 50% of this unit, which sort of made it tangible, and I was relatively young. Now that unit today, that particular unit, I just funnily looked it up the other day, is $800,000.
Jeez.
Right. Well, I paid 46 and a half. Now that just kind of puts the numbers into perspective, and the Australian property market is a little bit different to the USA, but you know, that's where it's at now. Now, after that, I left it for a long time. So it wasn't till then I thought, after I bought another house, I need to do something with these shares, and it was then I started buying Rio. Fortunately, I started buying Rio.
Yeah, so that's been a common thing I've noticed in a lot of the interviews I've done so far. Is it seems like not many people start on dividend investing, and they seem to like stumble into it. Do you know, like, what do you think is about, like, is it too, like, you think like the penny stocks and stuff like that are always more volatile, so you can make or lose a lot of money really quick, and typically with dividend stocks it's slow and steady wins the race kind of thing? Do you think that's what contributes to it, or why does nobody just like start investing and they're like, I identified I want to start with dividend investing? Like, why do you think that is?
Yeah, I think you've hit the nail on the head, really. I guess everybody starts off, no matter what they say, everybody starts off with some kind of gambling mode within their head, but they're thinking, no, but I've bought this really great company. Nobody ever wants to say, you know, it's a piece of shit. They want to say, you know, no, I've put $5,000 into this thing and it's going to be a 10-bagger. Everybody thinks that. And then that's why I came back to that check, because it was, now, at the same time, on the Warren Buffett principle, I paid $18.25 for the stock, right? So I've only bought it 3 times in my life. I think I paid $18.25, $28, $29, and $105. So it was just a position I held, but when I got that piece of paper, it kind of made sense to me. Like, Dave, what are you trying to do here? And of course, the particular group, you know, it's called Dividend Growth Investing, and you'll see lots of guys, particularly USA guys, making that point that, you know, dividend traps and things like that. So that was, in essence, how I slipped into it, which is sort of what you're saying.
Yeah, I mean, I think you have to go through. It's almost like a natural progression. Like, everybody starts with not knowing what you're doing. Like I've said this story before, but I went on Robinhood. That's where I started. I actually
Yep.
opened Robinhood several years before. I think it was like back in 2016, 2017, I opened it. And I was looking up Apple or Nike or something like that. And I was like, okay, like I want to do this. But then I looked at the price and I was like, wait, I got to put $100 real into this. Like that was scary.
Yeah.
So I was like, I
Yeah.
didn't do it. I closed the app. I was like, we're not going to worry about it. Then COVID happened, and I started watching a lot of personal finance channels and stuff like that. And I was like, okay, it's time to start investing. And my criteria to pick a stock was on Robinhood. They had your biggest winners and biggest losers. And I just went on the list of biggest winners, and I was like, okay, this one was the biggest winner. I'm going to buy that one. Because, you know, if it goes up in one day, it's going to go up in the second day. That's not how that works. Yeah. I mean, and then I started looking into that. And like I said, my realization was almost like yours, except with a lot less money. I got a free stock that was SiriusXM, and they pay a dividend. They pay one penny per share, and I got one share for free. So it was in May. It was around this time of 2020. I got my first dividend. It came on my phone and it said SiriusXM paid you a penny in dividends. And I was like, why did they pay me and what's a dividend? And then that started the whole thing.
Wow.
Yeah. So it was pretty
That's
cool.
terrific.
It's so weird. Everybody I've talked to, like, dividends are always an accident. But then everybody that I talk to, they're like, that was the best accident I've ever had.
Yeah. Gotcha. No, that's a fantastic story.
It's super cool. Super cool.
Yeah, and the amount kind of doesn't matter. The fact that you got the penny, you thought, hey, wow, you know?
Yeah. Because I didn't do anything. I was doing something else, minding my own business, just moseying about my day, and then I get an alert on my phone that said you got money. And, you know, where there's, you know, what they say, all these sayings of, you know, do this, it'll pay you dividends, and you know, you just need that little bit of light, and then you start digging a little bit more, and you're like, oh, there's a whole thing to this. So,
yeah, fantastic, Troy.
yeah, and I mean, of course, there's different ways to do it, and right and wrong ways. But relative to me, there's right and wrong ways in general, but there's also right and wrong ways depending on where you are in your journey. If you need the income, you might be more inclined towards the higher yields. If you don't need the income, which is what I see a lot on that group, there's guys that are in their teens, 20s, early 30s. They have 30 years left, 40 years left, and they're over here investing in AT&T and Verizon. I'm like, what? What are you doing? Like, when do you need the money? Because you're losing capital on those. So,
yeah, I get that story, and I agree with you, obviously, but I still always think back to myself when I see those young guys and think, wow, you know, there's still nothing ever wrong with taking a dividend. But it's how you use the dividend. If it's going to be a night out in the party strip, well, yeah, I mean, you probably won't remember that in 20 years, but if it's utilized into something productive or a productive asset, then, you know, it becomes tangible, and from there, you know, I wish I could have. No one can go back, but you know, and it was a lot harder back then. If I was, you know, 20, trying to do what I do now, it would be nearly impossible, because you got to ring up a broker and they're all going to have an opinion and all that sort of stuff. Now that end of it's gone. I can just live or die by my own decisions.
yeah, that's really important. And I remember in your story when you said that you had $1,000. Did you? There were fees for that $1,000, right? Like, it wasn't just buy $1,000 worth.
No, massive fees, like $1,000, I think, cost $80 AUD.
Yeah.
There was some massive. You can see why brokers didn't want to give this stuff away, right?
Yeah.
It really wasn't until 1998 that I remember having a big box computer and, you know, dial-in internet, and we would have been behind you guys, no doubt. We still are with regards to internet back there in Australia. Thailand's very good, surprisingly, but, you know, if you remember the old...
Yeah. You can't use the phone at the same time kind of thing.
And all of that, and I thought, wow, this is bloody fantastic. You know, how good is this? And then you get a phone call in, you get cut off because it was landlines, you know.
Yeah.
And but I had this thing on my screen. I could create a watch list, and back then you still couldn't. Well, I suppose you could buy in USA, but you had to ring somebody up. You can't just do it like what you can now. And but, you know, to me, that was another groundbreaking element. Now we had the .com boom and all of that, Everybody thought they were the guru because everything was going up, and no, just buy this, buy sausage software. We had the same stuff as you did, but just on a smaller level, but it was still a bloody high level, until it all crashed. And yeah, but look, it was. I always had that in perspective. I always thought, no, this is not going to work. Long term, because you're picking a needle out of a haystack. How are you going to find, outside of, say, if you just said, look, I'm buying Microsoft and I don't care, I'm just going to buy Microsoft.
Yeah.
And whatever happens, you will have obviously done great.
Yeah. Yeah. A lot of times the best strategy is to make your decision and then don't do anything to it. Just let it work.
Yeah.
And that's what happens with the penny stocks and stuff like that is people can be more active with it because it's so volatile. And with the other like higher quality stocks, they typically tend to be less volatile. So they're like, okay, like it's almost like I don't know if you've seen the meme where somebody's like poking it with a stick and they're like, come on, do something. Like it's kind of like that. It's slower. You won't notice it on a day-to-day basis. But when you look back over 10, 20, 30 years, you'll really see the growth and compounding over time. So.
Yeah, exactly. I mean, it's quite incredible, really, as to all of my biggest mistakes, in line with what Warren Buffett says, has been selling, not so much buying.
Yeah.
And so I always take I'm 62, right? So I still stand there and think, oh God, I still sometimes do the calculations. Why did I sell that? What was the strategy? That's why on that page I always say, write a strategy. And probably some people think that's a bit stupid, but I just think when you write something down and you've got that file there, and you come back to the file and you say, okay, here's what, now you can change it. It's no problem, you can change it. But you come back and say, here's my strategy. Now, am I happy with that strategy, or am I going to change the strategy? I think that would have saved me a lot of money, because the ones that I sold that I shouldn't have, still haunt me a little bit.
Yeah. Yeah, I stay tuned for the we're recording this on 6/3. So on 6/5, I have my monthly recap video coming out that tells what I bought, all the kind of stuff. Stay tuned for that, because you just spoke on something I just did. So okay, so next thing. So you said you're 62 and you've been doing dividends since 97, right?
Yeah, say 90, 97, 98, yeah.
Okay, so you've been doing it for, what is that, 25 years?
Yeah, 25 years, although right at the start of that 25 years, I probably wasn't focused on dividends like you said. I really got focused on dividends after the 2007 crash.
Okay. Okay,
that was probably my real go.
Okay, so doing it for, let's just say 15 to 25 years, like in that range, what still keeps you motivated to be a dividend investor?
Well, I guess now that I've been able to create the lifestyle where it's here. So always my goal was to come to the warmth of Thailand and all that kind of stuff. And initially the idea was that, oh no, I could live cheaply or whatever. It's actually not that cheap here anymore. But so it just became, my focus was, to reach a certain income. And then from there, up until now, every year had been enhanced. So my focus was to replace a job, if you like. That was the idea. And that's what I've done. That's really what I've achieved. Now, took me too long in hindsight, but that's what's happened.
Okay, so that actually brings up an issue I know I'm gonna have is, like, I'm very competitive, and I'm also very you can call it greedy. Like, to me, if I have $1, like, I'd love to have $2, and if I have $2, I'd love to have $3. So how do you know, or how would I know, or how would anybody else know when they have enough? Like, when is enough enough?
Oh, when it's yeah, well, that's yeah, well, that's the question, isn't it? I mean, I'm not, obviously I'm no Rupert Murdoch, but I'd like to be. Um, and enough is enough. But I think my answer to you would be that when you're into an accumulation phase, you're just going to accumulate anyway.
Mm-hmm.
So you know, if you're making 100,000, 200,000, 300,000 a year, I don't think that's going to make too much difference. You because you kind of couldn't stop it
Mm-hmm.
if you're in that mode. So for somebody like yourself, if you got to that level, you'd be thinking, well, look, it's just what you leave behind,
Yeah.
or just what you give away.
Yeah.
You know, in obviously in USA philanthropy and all that sort of stuff, it's a lot bigger kind of deal than in Australia.
Yeah, it's my thing's gonna be like because the compounding towards the end, the quote unquote end of the cycle is where you really see that snowball starting to kick in. Like year one
Yep,
to year two, you can notice it, but noticing it's like $50 from here to here. But
yep,
the longer you go, it starts to get into the hundreds or thousands or maybe even tens of thousands of dollars each year. It,
yep.
it just keeps going. So I know my issue is going to be like, okay, in year 22, because I have a 22-year plan. I want to retire by 50. So
Nice,
in
nice.
year 22, I know, like, let's just say I'm going to make $60,000. I know if I wait one more year to year 23, that could be $70,000. And then one more
Yes,
year to year 24 could be like $82,000. And I'm just like, okay,
yeah,
like,
yeah.
when do I set, like, it obviously depends on like my health, the family, what kind of job I have, if I enjoy that job, stuff like that. But like, pretending my health's good, the family health is good, I enjoy my job, like, do I stick in there for another year or two, or is that year or two turn into 5 or 10 more years? And then, like, I don't know. I feel like I'm just gonna be like, okay, if I take in one more year, I can make an extra $15,000, and I don't know.
Yeah, yeah.
That's gonna be something I know
I'm
I have
t-
an issue with.
I'm kind of thinking that if you were let's say the equivalent of, you were making the equivalent of $80,000 US. Um, Realistically, like if you're in the right stuff, it's going to become 100 anyway.
Yeah,
So I would say to you, you know, from there, don't necessarily not don't make money. I mean, shit, keep making money, but
yeah,
make money in a way in which you enjoy it.
yeah,
So whatever floats your boat, you know, it might be, could be whatever.
yeah.
Um, so I'd say don't give up on that cause. You know, and you're fortunate. You're young, and yeah, I'd love to be in your position.
Yeah,
But
I tell there was a guy at the gym that I was talking to, I don't know, probably a week or two ago, and he was 19, and we always talk about different workouts because I've been working out for the last 12 years. So like I get a lot
oh,
of
great.
people that come to me and ask me, like, they see me lifting weight and stuff like that, so they'll ask me a bunch of questions. And he was talking to me, and he was like, "Hey, what are you doing this weekend?" I was like, I have to record and edit and stuff like that. And he goes, "Oh, really? What for?" We got to talking about the YouTube channel, and I was telling him, and he told me he was 19, and I was like, "Dude, if you can take anything from a random stranger," I was like, "get started investing." I was like, all you need to do in the
Yeah,
beginning is just like put it in the S&P 500 or whatever. And
yeah,
what's going to happen is over time, you're going to notice that your money's growing and you're going to want to know more. And then, like, in the meantime,
yeah,
you're invested and you're growing. But then once you want to know more, then you can start divvying out the little individual stocks here and there if you want, or no harm, no foul. Just keep putting all your money in the S&P, not all your money, but the
yeah,
investable money you have into the S&P 500. And I was like, 30 years from now, you'll thank me.
yeah.
So
Great advice. Great
yeah,
advice.
and it's
I mean, well, you look at what Warren Buffett says with regards to his wife, you know, like along the lines of, well, she's not interested in it. What would he do? He'd put her into an index.
yep,
I mean, well, so that makes sense. I mean, what if you're not interested in it? That's fine, but why would you want to not be in an index?
yeah,
Um, and I do see some of the guys on that group sort of, even though it's meant to be dividend growth, you know, chasing something that I clearly know that they're not matching the index.
hmm,
And if you look at Australia, and I'm guessing USA is the same, a lot of fund managers don't ever match the index.
nope,
So why are you giving your money to some fund manager who's charging you 1%? Um, on the hope he or she's gonna have this super year.
Yeah.
It just doesn't make sense. So sure, yeah. Like my daughter, she lives in Denmark. She was born in Australia, but she lives in Denmark, and she sold a house. Property in Australia is expensive. She had like an $80-something thousand profit, no tax because it's PPR, principal residence, and I didn't want her to blow that money, So I just put her in the Aussie one, Vanguard VAS top. Now the great thing about VAS in Australia, and you have obviously much better over there, but that gets her ASX 300. Now taking out of the 200 and going into the 300 is a big difference because you've got that element of growth within the bottom 100 and the top 200 is basically all banks and mining and all this sort of stuff. Australian market's so different. So, but it's a core of a principal. Capital is fine. It's a dividend each year. And I say, okay, and you pick one more. So she had a bank account with ANZ Bank. They got the 4 pillars policy. Okay, okay, buy ANZ. I don't argue. I just and that's what we did with the 80. Most of it's in VAS.
And how long ago was that? Like, is it now significantly more, or did she use that money
yeah. And you know what? She wouldn't even know what. This is my point. She wouldn't even know what the price of the thing is. She doesn't look at it. I look at it.
Yeah, that's good. That's probably for the better.
So it's probably doubled. But ANZ, which she picked, is just flat. I mean, the problem with the ASX is that the index is basically big miners and banks. We don't have too many of those progressive companies like what you have in the NASDAQ and all that end of it. It's boring. It's good when it's going down because it's stable, but it's not good when it's going up.
Yeah.
And so ANZ, I've held ANZ too, but it's done nothing for a decade. Yeah, you get the dividend. 7-8%. That's not even tracking inflation. So, ANZ no good, but VAS has been very good.
Yeah, that's pretty cool. Okay.
So
So next one would be, kind of in that breath, it would be like, what is your biggest dividend related mistake, and what was the lesson you took from that?
Oh, biggest dividend related mistake. That's a really good question, isn't it? So it probably still comes back. It probably still comes back to selling something, I guess. That there was a dividend script, which I've got in my head, IGO, which is Independence Group, which is a Australian miner. And the only other thing I'd say is probably buying the banks. Australian banks are really just a dividend play. They're a dividend property play. So that might sound nice, but you ride the up and downs with everything else, but they've done nothing for 10 years. So probably being invested in 3 of the big 4 Aussies banks is probably my biggest mistake, I'd say.
So what would the lesson to take away from that would have been, like, your money would have been better off in that index fund, or instead of picking those individual stocks, or what would that be?
I would have said it would have been way better off in VAS, Vanguard, ASX 300 than what it would have been in just doing Aussie banks. Now they're still in Aussie banks, but again, I got that bottom 100, and I'm sure that would have been. Well, I could look it up, but it would be way better.
Yeah.
Because So I wouldn't have matched the index there. So that's not a claim to fame.
Yeah. The other thing is, like, especially with me with the YouTube channel, like I felt like I needed to, my investing strategy is pretty boring. Like, I haven't been adding a bunch of new companies. Like, I keep my same companies and I just keep adding to them every month. I actually add to them every day. So like, I didn't want to do like a weekly update where it's like, oh, yep, bought the same 11 companies I bought last week for like the same amounts. Like, that wasn't fun. So my split the difference was I have a Roth IRA, which is the tax sheltered account here.
Yes,
I have that,
I've
and
read
that
about
is
that.
all of my ETFs. I have like 6 different ETFs and Tesla in it. So it's VOO, it's which is the S&P
Good idea.
500. It's the
I know VOO. Yep.
VNQ, which is for real estate. And then QQQM, QQQJ, stuff like that. And then I have Tesla. Just that obviously they don't pay a dividend, but it's just for growth.
Yep.
All that stuff is my set it and forget it. Just put the money in there, add money
Nice.
whenever, and just leave it alone. And then my taxable account is because I would be bored just investing in the S&P 500. So that's those are my individual stocks, and that's where I have like the likes of like Apple, Microsoft, Visa, APD, like stuff like that.
Yeah.
So I have those in there. So it's kind of one of those things where often the best thing for you to do is the most boring, which is the index funds, which I wanted to not miss the gains on that, which is why it's in my Roth, and it's tax advantage, which is cool. So
Yeah, big advantage. Right?
yeah, and then I just have all the individual stuff over here, and that's what I get to play with, and that's what I show everybody and stuff like that. So,
and Troy, does your so in your Roth IRA that I've been reading all about in the group, and I sort of understand it, it's similar to an Aussie superannuation. So, does your company also contribute? Like, does the match contribute as per what you put in?
I think for me specifically, it doesn't. So that's a 401k, which is like a retirement account.
Oh, okay.
So the 401k, the employer I'm with doesn't have the best benefits, but they at least do a 3% 401k match. So I make sure I get that because that's free money. That's a 3% guaranteed return forever. So I put 3% of my paycheck pre-tax, and then they match 3% of my paycheck also. So that's free money.
And sorry, is that just the maximum you're allowed to do? You can only do 3%?
So I think for 2023, the max 401k contribution is like $22,500 or something like that, which is a lot. And obviously, the more you make, it doesn't change how much you can contribute. But if you make 100,000 versus 30,000, you're probably going to be more likely to put that full amount in there versus that 30.
Gotcha.
So yeah, I do 3% because my goal is to retire early. And you don't have access to the 401k or the Roth IRA till 59 and a half. And if I plan to retire at 50, I need to have a supplemental account that can get me to retire at 50 till 59 and a half. And then you don't get Social Security here until, I think you can start drawing at 63 or 65, which who knows if that's going to be a thing by the time I'm, 63 or 65. So my plan is but
you want to wait. I mean, well, on the current rules, you want to wait to be 70.
Yeah.
Don't you? Because like Warren Buffett gets it.
Yep.
Aussie Paul Hogan gets it.
Yep.
All these people are multi-millionaires, so you may as well maximize it out and leave it as long as you can, get free money.
Yep.
Whatever the age is then, as you say, that will probably change, I'm guessing.
Yeah. Well, yeah. So mine's really like a step stool approach where if I can get to the point in 22 years at 50 years old where I can retire just off of my taxable account, at that point from 50 to 59 and a half, I need to live, I'll be able to live off of just the taxable account dividend income. And then at 59 and a half, I call it like, here comes the troops, here comes the support. I have the 401k and Roth money that I will get, and I'm going to get those tax-free as well. And then so that's from 50 to 59 and a half, 59 and a half to let's just say 70. Nice. At 70, I'm going to get more troops coming in the form of Social Security. So I was already able to make it at 50, and then 20 years later, I'm still going to be getting new money from somewhere else. So it's just kind of setting up different streams of income, which is going to be pretty cool.
Yeah, I love the way you're thinking. Yeah, that's so good.
Yeah, I appreciate that. It all works in my head. I'm sure there's going to be some kind of wrench that gets thrown in there or whatever, but we'll see.
I don't think so. I don't think so. It's more an attitude thing. And, you've got the attitude and the insight and the interest. The big thing is to have the interest, and you got the interest, so I don't think you'll have a problem.
Yeah, I really hope you're right. That'd be cool. Because that's the other thing that stinks, too, is like me being 28, I'm trying to plan 30 years in the future, and I haven't even lived 30 years yet. So it's really hard to zoom out and say, okay, what would I do in 30 years? I'm like, I don't even know what I would do with the first 30 years because I haven't had 30 years yet. So
makes sense, mate.
I think that's one of the hardest part for people to put their mind around, even if you are over 30 and you're trying to plan 30 years in the future, like You just don't know what the world's going to be, where you're going to be, what your health's going to be. There's so many variables, and trying to plan for that, I think,
Yeah.
is why most people wait. I know so many people that are like, oh, once they hit like their 40s or maybe 45 or 50 is when they start thinking about retirement and like start investing. And I'm like, the amount of time and money you've missed out on by waiting until it was not necessarily too late, but like if you would have just, like you said, boring $50 a paycheck into the S&P 500, into an index from the time you started working until the time you care about investing, like you would have had so much more money and set yourself such on a better trajectory. So
Well, exactly. That's the whole thing. You know, I mean, gee, even if you brought one USA REIT, you know, like what's the company? O, right?
yep,
O.
realty income, yep.
Yeah, and just said, okay, I'm just going to do O. I don't care about it. I don't want to do it. I don't care about the index. I'm just going to put whatever I can a month into this. Uh, I'm sure I think that's a great rate. Great rate, that one.
Mm-hmm.
Because of its size, and okay, it's got the office in there, massive scenario there.
Yeah. I mean, I could honestly argue like that's the one thing I love about that group. It's got nearly 70,000 members in it. And
Oh, really?
even if you're starting, and in some people's opinion, maybe even including mine, you're starting off on the wrong foot, the important thing's that you started. So even though you're putting your
Yep.
money into something and it might not be making you as much, most things in investing are just opportunity costs. Like you might not lose money on your investment, but could you have made more money elsewhere? Like that's typically what you're doing right there. So I could argue that even a person that doesn't know what they're doing, just getting started, like say it's an O, or say it's like a stock I really don't like is like anything in the communication sector. So AT&T and Verizon, not a fan of either one of those. Even if you started with that, if you actually pay attention to it over time, you might not get the capital appreciation in terms of money back, but what you're going to get is capital appreciation in terms of knowledge, and you're going to learn
Yeah.
why it was a good or bad investment, what you could have done differently. And like that's the same thing with me. SiriusXM, free stock, only paid me a penny, but that one penny is what got me triggered into learning about investing and dividends in general.
Yeah,
So
yeah.
it was really worth it.
I think you're spot on. I think the big thing is to be involved, and that's why when I look and see young people in there, I mean, even some of the things they say, I think they're overthinking it, but I think the fact that they're involved is the main thing.
Yeah, I
And
agree.
they'll work it out for themselves. They'll work it out what floats their boat, because there's lots of different ways it can work.
Yeah.
You know.
Well, the just this week in the group, I think I've seen like 2 or 3 different people mention that they were selling Verizon and AT&T, which, like I said, I'm not a big fan of either one of them. But not only did they say they're selling it, they mentioned that they were down or whatever. That's not the important thing. But what they also justified it with why they're selling it, and almost like the lessons learned from holding that position. And I'm like, you understood the lesson. Now, what happens is if you sell AT&T because it didn't do good for you and then just go into Verizon because you think that one's going to be better, like something like that, you didn't learn the lesson that you were supposed to take away. If you buy AT&T, buy Verizon, and then you hold it for a certain period of time, one, that taught you to buy and hold, which was good, but you also saw, hey, this didn't work out for me. Why didn't it work out? And then you can apply that to your future investments, which is going to make you tons more money in the future.
Exactly. Well, I mean, there is a time sometimes that you do have to sell, and I mean I have one classic example for me, which was we went through a time in Australia when we had plantation timber. Plantation timber was this huge thing, and the reason it was it was meant to, they're going to make all this paper and it's going to be super high quality and all this kind of stuff. And if you put in whatever you put in that year, say of your taxable income, you got a tax deduction for that same amount. Now, of course, you're putting in $1 to get back 48 cents. So it's not completely a free lunch. But this thing, I happened to get into it right at the beginning. And my reasons for starting off was because I had I saw that green was going to be a thing, but probably not for the right reasons. I probably wasn't completely into green, but I thought, well, people are going to follow green. It's going to be solar and all sort of stuff. And so I started buying this company before it was listed, as in contributing to these trees. And so, of course, when it floated, you're involved. I got the first options on, so I put in 20 grand back then, which was a lot for me back then, and at $1 a unit. But this was back in the techno days, even though it wasn't a techno company. But this thing flew to $4, and then it crashed way back to 35 cents. Right now, I'd already paid $1, but I knew at that point it wasn't going to go broke. So I started buying back in at 57, and I built this position again. Now back then my thought was this was going to go on forever. This was going to be great. It was a great yield because they paid the yield out of the money that was coming in off the sales. And I remember I had 115,000 units when the thing reached its absolute peak at $5.03. 115,000 units unencumbered, and I'm at the Crown Casino in Melbourne, sipping a Chardonnay in the front row. Now there's thousands of people there and thinking, Jesus, how clever am I? Well, with this great Southern Plantations, that was the top, 503, which was that night, that was the top. My 600 odd grand that I had. Now, the 600 odd grand I'd put in, I sat there and worked it out, I put in 84,500 contributed. So I came out and I thought, geez, I've got to protect this 84. It started to drop like a stone. And I sold the 84,500 at $4.15. But I still then believed in the whole thing. So I thought this is going to work, still going to work. So I took out my 84, so that was just, it contributed. I was getting nearly 20 grand a year in dividends at one point. Jeez. Off this thing. But of course, kept coming down. Yeah. So this is when I first started writing strategies. So I said, no, I've got to write something down because this is, I've got to stick to it. And so I said, okay, I made my base $2.70. I sold the lot at $2.72, and there's a little bit of a hangover. Some units that I got for something that it just kept going down, and the company's broke today. Every plantation company is broke. Wow, they all went broke. So that was one kind of expensive lesson to a degree. Could I have done it better? Well, can you ever pick the top? I wouldn't have picked the top with my mindset at that point because that wasn't my mindset. I was glad I took out the 84. Yeah. People say free holding. Well, it's not a free holding. To me, it's like when you see people playing what you would call a slot machine, and they win $100 and they stand there and say, "Oh, I'm playing with their money." No, you're not. It's your $100. You've pressed the button. You've got the 100. You can walk away. So it's not a free holding. You've built that. Walk off. Now I should have just sold the whole lot, but as soon as I saw the risk, but I did still think this plantation timber had a future. Yeah. And it didn't. So look, another lesson learned, and it didn't cost me money. Over 10 years, including dividends, minus what we call franking credits, which is a taxation credit. I don't know if you have the same thing over there, but taxation credit when you do where the company tax is prepaid, you get a franking credit in Australia. So everything was fully franked. That makes a lot of difference when you do your tax return. And so I would get a nice refund each time, and I realised, no, it's not going to work. And at least I was able to get out at a certain level.
Yeah, I think setting those nobody will ever, or rarely do people set top side limits of like, hey, if it ever hits this, I'm gonna cash out, because nobody ever thinks it's gonna stop. Like you did, like you said it hit 603, I think, and you're like you would have said
503.
yeah, 503. Yeah, you're like, oh yeah,
I had 10 in my head, mate. I can tell you, $10 was there. It was
so
doubling.
you're just like everybody always thinks there's always more. Like there's always room to go up, and you're just like, okay, like some people will set a bottom side limit, like you said that you set, and it's just so impromptu question on that. I see people in the group that say, let's just say it's Apple, and let's just say Apple's trading at $150 a share. They will say, I believe Apple's fair price is $145.50, and they won't buy Apple because it's not $145.50. What are your thoughts on? I try to tell people, figure out how much money you would like to put into Apple that you have available right now. Buy it when you identify it as a good company, and then however long you have until you want to get all of that money invested, like say it's a month, like I have $10,000 I want to put in Apple, I want to get it all invested in the month of June. What I suggest, and obviously not professional advice or whatever, but what I suggest is like, hey, you identified Apple at a good company at $150. Put a quarter of it into Apple at $150, and then every week put another quarter of that money in until you're fully invested, because you never know if Apple will ever hit $145 or whatever the other price is I mentioned. So like, what are your thoughts on like quote unquote timing the market like that?
Well, I'm with you 100% on that. If I've decided I'm going to buy Apple, and I've got X amount and the money's there, my advice would be just effing buy it. Yeah. Because if you've paid 150 and then it becomes 140, what are you genuinely going to buy more because it's 140 than when it was 150? And then what if it's 130?
Yeah.
You've said this is what you're going to do. What ends up happening, I believe, to a lot of those people, is they end up doing nothing. Yeah. I see it all the same in the small caps group in Aussie One. So they say, I'm going to buy X when it's 14.5 cents. Well, hang on. Then it's 14.5 cents, and you're telling me you're going to put 20 grand into it, and then you don't.
Yeah.
Because how are you going to stand there and say, you call it catching the falling knife or whatever you want to call it. But you've said you're going to buy Apple. Just buy the thing. Don't stand there and we're talking about absolutes.
Yeah.
So you're talking 140. I'm at 130. Oh well, why can't it be 120?
Yeah.
It just doesn't make sense. And then you come back. Oh Jesus, Troy, I missed that because I wanted to buy it at 140 and it got to 142.
Yeah. Well, so I mean, this is a bad example because it actually happened. But I know a lot of people that were waiting for SCHD, which is like, the group's prize possession.
Yes.
They were waiting for that to drop to like 69 something. And like it went up for a while and it didn't look like it was going to come down. And I'm like, okay, like that was one where people were, quote unquote, right. But I was like, there's been several cases where you just create this imaginary number in your head that you want this stock to get by. And then some people I've actually seen people like older people in the group that are like, yeah, back in the day I wanted Apple or Microsoft to be at this amount and I never bought it because it never reached that. I'm like, so you missed out on thousands of % gain because you wanted $2 cheaper.
Exactly.
And I'm just like, that doesn't make any sense.
And how are you going to pick an absolute like that? So you're going to say you're wanting something to come down from 160 to 140, say. So then you're saying I've got 20 grand to go in at 140. And then the thing comes at 140 and goes to 138. So you don't do it because it's going down. And then all of a sudden it's 150.
Yeah.
Well, when are you going to do it?
Yeah.
I'm sure that most of those people end up doing nothing.
Yeah.
And that's the biggest risk of all.
Yeah. And at the end of the day, 20, 30 years from now, like, are you going to care that because most people don't lump sum it anyway. Most people will buy it today and then they'll be like, oh, okay, I have more money, 6 months from now or next year, and they buy it again.
Sure.
And like their cost basis is going to rise anyway. And I could argue that like you wouldn't care if you had 1,000 shares of Apple at 142 or 130 or 143.50. Like that's not going to make, I mean, yeah, it's a percent here or there. And I know percents here or there over time matter, but like the opportunity cost is, would you rather miss out on maybe a percent or two or miss out on the thousands of percent because you never bought it?
Exactly. I mean, look, if you believe the Apple story, and I think it's a bloody great story, can you really see that company not going from strength to strength with the group of people they've got?
Yeah.
That are just going to remain, I use the word addicted, but, it's very hard to change away from Apple.
Yeah. Well, they got the ecosystem, like, not only is it their phones and devices, but now it's starting to get into like credit cards and bank accounts. They're getting into VR now. Like they're getting into healthcare. Like they're getting into so many things where like the more things that they create, and they create quality products. Now they might be more expensive than people are used to, but they create quality products. And the more like I have an iPhone, I don't have an iWatch, I have a Fitbit, but I have AirPods. So like they already have me where like I really like my iPhone and I really like my AirPods. Now I like to save my money to put it in the dividends, but I know people that have the iPhone, the AirPods, the AirTags, the MacBooks, they have the whole ecosystem. I'm like, I think there was a question, I forget who asked it, but somebody basically asked, if I could give you $10,000 for you to never use another Apple product today, would you do it? And a lot of people said no. That's how deep their moat is, where they just have people, and it's not a bad thing. Like it's no, don't feel guilty that like, oh, I have an iPhone, I fell for the Apple trap. Like that's just letting you know that their brand loyalty. When they put a Apple with a bite out of it, you know who that is.
You know who that is, and I mean, look, I've just had my sister here, who's like 75 years old, right? She's nearly a Luddite, but she's got and just a perfect example. She's got this 1600, what was it? 1650 latest Apple bloody phone. She can't even use the camera. She went to a class to learn how to use the camera and can't even use it. Like, I mean, I'm thinking, geez. I mean, I was more looking at it from the Apple perspective, thinking, God, how did they get her?
Yeah.
But I've got another guy down here in Building 7, UK guy. He doesn't know much about computers or that kind of thing, but he's got some cabbage, and he's got the full smear because he's frightened, and he's frightened to change because he wouldn't know how to work an Android. He's not going to change. He's used to Apple, and that's how I think it's a fantastic company. I see why Buffett's got so much of it, and what is it? His only tech company. Or something like that. I mean, I think that's a great investment. I don't think you go too far wrong with Apple. I don't think you go too far wrong with Tesla.
Yep.
But I think Tesla's probably more risky.
Yeah.
Only because of the individual involved. But the great thing about Apple is you lost Steve Jobs, and it still went power. Mm-hmm. So in a way, Steve Jobs, even though he's genius, sort of held things back to a degree by being that figurehead.
Yeah.
And now you've got all of this talent in there that's going, wow, it's an incredible company.
Yeah. Yeah. I really like the individual stocks. Like I try not to make my strategy too complicated. Like my 3 pillar metrics are outperforming the S&P 500 over a 10-year period, dividend streak of at least 5 years. That shows me that they have consistency of paying and growing their dividend. And then I like a 3, 5, and 10-year dividend growth rate above 10%. Just because that's a passive income raise of double digits every year, and I'm not even doing anything. So like, I realize that like Apple doesn't necessarily meet the streak and they meet the outperformance, but they don't meet the growth rates. But like certain companies, I'm willing to sacrifice. Like I don't think Microsoft meets it either. I have both of those. But then I have companies like Visa. They meet. I have companies. I can't even remember all my companies. I have 11 different companies. So like, each of those companies play a pivotal role, and I don't think they're going anywhere. So that's really important to me. But yeah, okay. So that was I don't even remember what the original question was, but that was a good conversation.
Well, so neither do I.
Okay, so you actually might have spoken on this before. So do you have a biggest selling regret or a biggest buying brag? Like a company that you bought like really cheap that's now worth a lot, or what do you have?
Yeah. do I have a selling regret? My word, I do. I got a couple. So what happened because of my so I used to be involved in new homes and land subdivisions, right, in Australia, and so we're going back to 1998, and what happened was so REA, realestate.com, it was called back then, very hard to pick out because there was all sorts of stuff happening, and others that may have competed. But what happened? The IPO, it's listed at $1. Now, I didn't know these guys, but I knew of two of the guys who came up with the idea originally, and was more out of respect for them that when the thing it dropped all the way down to 14 cents. And I thought, wow, if there's any of these things that's going to make it, it's going to be this, because like these guys really know what they're doing. Now, did anybody know what they were doing with tech in those days? Probably not, but they had a really good plan. And was it going to work? Well, who knows? But I bought $20,000 AUD. I can't remember how many units that was. I have worked it out to just haunt myself with my stupidity, because at between 14 cents and 18 cents. And I said, no, you know what? I'm just going to let it sit. But if it doubles, I'm going to sell it because there's too much risk with this techno. Anyway, a year later, it doubled and a little bit. So I sold it for a little bit more than what I said, between 28 and 32, something like that. So 20,000 was 40,000. Yeah, you never go broke taking a profit, right?
Yeah.
But that company, which is now 38% owned by Rupert Murdoch, News Corporation, and I haven't looked at it, but it's $130 odd bucks a unit. Plus, so not a 10 bagger, not a 10 bagger, forget 10 bagger. This thing was a giant, and I had $20,000, not 20,000 units, $20,000 at 14 odd cents.
Wow.
You work it out, but it's millions and millions. That was my worst. I have another story, which was which came after that, and I had what I was doing, because the new homes and land, I was doing new houses at the time, and I'd put the houses. I had a bit of gearing, but I put the house into a pool, and I took out. What did I have? I had. It was a lot of money. I had $250,000. There was $250,000 total, but I bought. Which was all going into the ASX. So I bought $60,000, and this is where, again, I came back to the strategy. I didn't have a written strategy. I bought $60,000 of Independence Group, which is a miner, big dividend payer, but I only buy stuff I'm happy to hold. That was always one rule I had. So I bought Independence Group. $1.60 I paid, and I said, no, I'm going to hold this forever. Then within the day, and this was just pure chance, the thing just, so back then you had 4-day settlements, right? The thing just rallied, and my $60,000 was 74, right?
In a day?
Within the day.
Wow.
At the end of the day. So I thought, I'll go in tomorrow. So it's now the next day. I thought, I'll go in, and if it's hold that price, I'm going to sell and take the 14, and I'm going to buy it back. I'm going to buy it back because this rally's not sustainable. This was my thought. So I went in the next day in the morning. I sold them. I made a little bit more than 14. Of course, the great thing, you never have to settle. It's kind of amazing. Somebody's just, I'm not a day trader, but somebody's just giving you $14,000 is how I looked at it, bang into the account, because you never settle. And that happened, but of course it didn't happen. That it corrected. It went the other way. Kept going. Oh, it can't keep. It can't keep going up till $3.20 odd. I started to lose a bit of interest with 100%. I thought, no, I'll look at it. Well, of course, my original strategy was terrific. The thing is $14 something today. Not quite a 10 bagger, but with all those dividends along the way, really good dividends were maintained, and my original reason was good. I just happened to hit it at the time when, it went bang, and came back to what you said before. What I should have done was what my strategy was, and I broke my own strategy and got greedy, took the 14, and the 14 cost me. Oh, well, I did work that one out the other day. It was 650 odd grand when you put in all the dividends.
Yeah.
So I think now, like I said in the beginning, all the mistakes I've made, the predominant mistakes I've made have been on the sell side rather than the buy side. I've made mistakes on the buy side, but not that have cost me anywhere near as much as they have on the sell.
Yeah, I mean that's a really good lesson to take away is that even if you buy a company and you put $20,000 in it, odds are it's not going to go to zero. And if you end up losing and you only get 5 out of it, like you lost $15,000, but the upside always has more potential than the downside does.
Exactly, and at the end of the day, it's like Peter Shaw, isn't it? He says that the upside is huge. Even if you put in 20 and you lost 15, your 15's tax deductible against everything else you did. If you did something else good, you're hardly going to notice it.
Yeah.
But my mistake was I didn't follow my own strategy on the first one, which is a much bigger mistake because there's millions and millions that I on REA that I gave away potentially. That was okay in a way because that was my strategy. With IGO, it wasn't. I should have held IGO because that's what I said I'd do. Mm-hmm. I didn't.
Yeah. Yeah. It's tougher to do when there's real dollars and real cents. Like like you said, nobody ever went broke taking a profit. So I mean, even in your lessons that you learned, like what you learned is that you could have made more, but at least you didn't lose money off of it. So that's good.
I didn't lose on either of them. They're sure, but yeah, that's right. But I missed the big side. I missed the big side, and it was partly due to my own thoughts.
Yeah, yeah. I wrote one of the guides I wrote. I think it was like the 10 rules for dividend investing. One of the rules in there was to keep your emotions in check because the emotions are what gets you 90% of the time. It's it could be a really good, like for Apple, for instance, when we were talking before, it could go from 150 to 140 to 130, and you're just like, oh, is Apple all of a sudden a bad company? Like, do people not like it anymore? Then you sell out, then it goes to 160, and you just missed all that money that you could have made or whatever. So
yeah,
emotions are they're pain, that's for sure.
And at the same time, you can have the same element like my Great Southern Plantations, where you're that invested in it mm-hmm. that you're in love with it too much.
Yep.
So the other way around, and thinking, no, I know this company so well. But probably the one thing I did right there was you had the two elements. You had the listed company, and then you had the investment in these damn trees. Mm-hmm. And I always did tell myself, if the guys who are putting money in on the other side, on the tax deductible side, don't make money in the long run, it can't work, obviously. Mm-hmm. Now, that might seem pretty basic, but there was a lot of people buying this stock, for all of the wrong reasons. So I had another friend who made great money out of it. He's a Russian Jew. He's a very smart guy. Lives in Australia, and he loved it. But even he sold. He had 437 units when I had 115.
Jeez.
437,000. So he was in it big time.
Wow.
And he had a lower buy-in rate than what I did, which my average was 57, I think, when I put everything in. So I still did okay. but he was down in the high 40s.
Do you still talk to this guy?
Yeah. So I do. He's back there in Oz. He's still got a lot of money still.
Yeah. So do you think so when you sit there and calculate like what could have been from some of your older holdings, do you think it's healthy to do that, or would you rather just not know?
Yeah, that's a really good question. So many people have said to me, why would you agonize at the age of 62? Why would you put yourself through that misery? And I guess it's probably just with the thought that you never stop learning.
Yeah.
Is it healthy? Probably not. But it just kind of makes me think twice about everything.
Yeah.
I know that I can't get that money back, or magically it's not going to happen. Or I'm even going to make a trade as big as that again, because it would be bloody hard for me to make a trade as big as that, because it's easy when something's just risen and we're talking about in theory it's not your money, it's this mystic. Like the Wolf of Wall Street, what does he say? It's it's kind of like that. So as soon as you make it ready cash, then it's real.
Yep.
And that was probably the essence of my 14. With GDP, well, it was I was on the inside to a degree, and so I could see, not insider trading or anything, but I could see a lot of money was going to go in there. Mm-hmm. It was pretty obvious that people were going to be, and it was great economic time. So, of course, people wanted this tax deduction. Trouble was the product didn't match at the other end. So, look, I guess you learn a lesson with everything, and sometimes to teach yourself how much you lost might be good, might be bad.
Yeah.
I can see 50-50.
Yeah. Like I said, stay tuned for the Monday video coming out, because you'll get to see what I have to say. So this is a newer question, and I've been getting some pretty good answers on it. So I want to know your opinion. So has dividend investing given you any bad habits? Like, has it created any bad habits in your life, or has it given you any good habits that you use in your life?
Yeah, I mean, possibly both. As in, if we're talking investing, because, as I say, it came down in 2007. When you guys crashed and we followed, not as badly, but we followed. And on paper, I lost a lot. I went, look, I'm just going to rejig this whole portfolio, and I'm going to focus on these dividends. That's it. I'm going to focus on what's real. Now, the good part is, getting the dividends. The bad part is standing there and saying, well, I'm going to buy NAB Bank, Westpac Bank, ANZ Bank. That's all okay, but if you look at it between 2007 and 2023, you've got the dividends, but you to a degree are in that dividend trap. So that would have been one of the bad habits. It was probably the first time I got involved in REITs. All of the REITs have done pretty well, but it has been a growth phase. They're all Australian REITs, so that has been a growth phase. That same guy I was talking about before, I told him, I said, this is my strategy. I'm going to do banks, gaming. When I say gaming, it was. I like the idea of not me gambling, other people gambling. I think people gamble,
Yeah.
But I didn't want to buy casinos. I wanted to buy lotteries. So I bought a whole heap of Tabcorp. That's done well. And REITs, because I knew property. And so the bad habits would have been probably sticking with the banks and buying them for a dividend, and the good parts would be just, I guess, getting those dividends and getting that point. So how I started off doing it was I was making good money doing this property, but I knew it wasn't going to last forever. So my whole thing was, I'm just going to pay off principal place of residence, right, which I still own but don't live there anymore, And my idea at the start, and I read a lot of people saying this within the group, I said, okay, how can I make back then $1,000 a month?
Mm-hmm.
So I wanted to get $1,000 a month AUD. So how do I get to 12 grand? Well, I got to 12 grand really quick. So I thought, well, hang on, if I got to 1 grand a month, how could I get to 2?
Mm-hmm.
You know, and 2 actually happened really quick. So I said, well, I set a really big goal. I said, well, if I made $1,000 a week, right, that's in my hand, you know, because I've got these franking credits, which will pretty much have paid the tax if I've got the right product in there.
Mm-hmm.
So I thought, well, if I got $1,000 a week, that's $52,000 a year. You know, in theory, I can not do anything. I don't have to work. Okay, that's not much money, but I thought, well, that's freedom. So how it initially started was I did get to $52,000 a year, but back then I used to had the PPR and I did like Airbnb, and that used to subsidise the rest back then.
Yeah.
To be, well, this is my job. This is now my job. I'm an investor and an Airbnb guy. And what I loved, obviously, I didn't make the 350 grand I was making when I was busting my balls doing this property, but I didn't have the stress that went with it either. You know, I do what I wanted every day, and so I kind of liked that. And I did some little other bits and pieces and make myself another 20 grand, say, a year, and that's how it started. And then I go, well, you know, I'm self-funded and just keep studying. So yeah, look, in answer to the question, certainly I'd say both good habits and bad habits.
Yeah. Yeah. I think that's really cool that I see a lot of people that do investing in general or just even dividend investing, and they don't set themselves goals and they don't track their progress. And I think those are two big mistakes I see a lot of people make, because if you don't set goals, you never get that. Even if it's a small, like you said, you got to $1,000 a month, and that might have been it was one, proof that it could be done, and two, it was like that small little bit of joy that you had in yourself, like, oh, that's super cool, I'm up to $1,000 a month. Then you were like, what can I do next? So like that's really important. And then tracking the progress. That's what, like, I have my spreadsheet, and there's gonna be up and down months, because like I have a lot of payers in May, I have a decent amount of payers in June, but in April I don't have a lot of payers. I only have one company that pays out 14710. So like I don't compare April to May, because that would be unrealistic, just like I don't compare June to July, because that's unrealistic too. But what you do is you compare April to July, and then you compare July to October, and like you compare the sames and you track that progress, and as long as it's going up and to the right, you know you're doing something right. Like you just need to give it more time. So I always tell people, have a goal and then also track your progress, and both of those things together will get you where you need to go.
Yeah, that's spot on, because you know, the big thing I think for me was when I had the 12 grand. The 12 grand was a good idea, because what I did from there, I did kind of what you're saying. I set up a spreadsheet. I set up actually a manual spreadsheet, because I like writing into it. I like making the adjustments. And I said, okay, I've got $1,000 for 12 weeks. Now I need to get $1,000 for another 40 weeks.
Mm-hmm.
How am I going to do it? So you know, what do I need to do? So which ones are working, which ones aren't, and then of course, you know, you research things, and it was surprising, even from the 12, how quickly I could get it to this 52.
Mm-hmm.
And when I wrote in that 52nd week, it was like, wow, man, like it was an emotional win. That I think that was the biggest thing.
Mm-hmm.
To stand there and do that, and then think, well, on the same thing in percentage terms, if I made 12,000 into 52,000, why can't I make 100,000?
Yeah.
That was where I went.
Well, and it's I don't know if you've ever seen, like, there's pictures online of like let's just say it's like a wooden ladder, and it has like the little rungs going up each one, and a lot of people make the mistake of making their initial goals too big. And then they end up like they lose motivation along the time, because along the journey, because it takes too long to reach those goals. So I think it was very important what you did, where you made the goals big enough that you had to work towards them, but not big enough that they seemed unattainable. And that's what I see a lot of people do, where they're like, okay, I want to, like, their main goal is I want to retire off of dividends, but they have no goal between now and then. And I'm like, the odds of you keeping focused, never hitting a goal for 30 years, and then one day, 30 years from now, hitting that goal and being excited about it, you're gonna lose your luster after a time. But if you make it where like, I want to see if I can make $10 a month in dividends, then you get to that goal. You're like, cool, can I get to $100 a month in dividends? Cool, $500, $1,000, and it's all about trying to climb. Imagine trying to climb a 6-foot ladder and it's only got one rung 3 feet up. That's a hard ladder to climb. But instead, if you have a 6-foot ladder and there's a rung every 12 inches, way easier to climb that ladder.
Exactly. No, good point. And I think you're right. Those goals have to be attainable.
Yeah.
If the goal's not attainable, you just make yourself depressed. No, I was just incredibly surprised that now, okay, the market was good and all of that. It's tougher now and all that kind of thing. To how I got there relatively quick, and then it was good because it helped me with at the time the Airbnb. Mm-hmm. Because, believe it or not, because I focused on that. Like, okay, what am I selling here? How do I? And when I was focused on that full time with no, job that I had to go to, all of a sudden my bookings were out of control. Mm-hmm. Whereas before I'd go, oh, fuck a booking, because it meant a lot of work.
Yep.
So now I had time to do it, and I was always booked out. So it was little things like that, and it enabled me to do some other things. And I used to own a golf shop, so I fiddled around with some golf clubs and stuff like that, as I had time to do all this stuff that I couldn't have possibly done when I was trying to make the big bucks.
Yeah.
Which, okay, I was, you could say fortunate. Like, I don't like your word lucky, because I think luck is the way you describe the success of people you don't like.
There you go. Yeah, that's good.
But fortunate, I'll use the word fortunate, that I was able to be in a position to make that money. And I figured then, well, some people can't. Yep, Dave, there's going to be times when everything gives you the shits, but you just got to slug through that, because you can't make this money forever. So make the money and use it for something else. Don't have a flash car. Don't worry about all that shit. Just keep doing things, productive assets, and that's just what I kept telling myself. And that's kind of what really helped.
Yeah, those are all super important takeaways. And like, that's one thing I've started to realize, like, over time, is you do have to, now, while it sounds way better to make $100 a month in dividends, or $1,000 a month, or $10,000 a month, like, those are nice round numbers. Setting those smaller goals in between will help you get there faster than you think. So yeah, I'm glad I realized that. So I do have 2 subscriber questions. These are from Lewis, and he wants to know if you have any familiarity with the Dividend Kings or Aristocrats list.
No, I don't, to be honest.
Okay, so the Dividend Kings and Aristocrats, it's kind of the same list. So the Dividend Kings are dividend companies in the United States that are, I believe they have to be members of the S&P 500. And to be a king, you need to have paid and increased your dividend for 50 or more years. And then the Aristocrats is the same thing. I don't think these need to be part of the S&P, but a lot of them are. The Aristocrats is 25 years or more. So you can be on the Aristocrats list and you're also a king, because Coca-Cola is an example. I think Coca-Cola's got 61 years in a row where they've not only paid, but they've grown. So
Johnson & Johnson, that sort of thing.
Yep, Johnson & Johnson, Procter & Gamble, Pepsi's on there, like stuff like that. So his question, now that you kind of have an idea of what they are, he wants to know, what do you think about those kind of lists for beginners?
Wow. Well, look, I think, it sounds a terrific list to me. Mm-hmm. Because I love tangible. And, the great thing about your market, again, taking from Warren Buffett, as Warren Buffett says that the greatest thing was that, he was born in America and born a male, because he said 50% of were excluded. And look, I think that's right. So again, you read my comments in that group. I always say to the young people, never be frightened of taking a dividend. Mm-hmm. So people might say that, Johnson & Johnson, that's boring. Where's the growth going to come from? They're not doing anything to. Yeah, well, they've still done pretty damn well.
Yeah.
Look, will it be an Apple? Probably not. But again, nothing wrong with taking a dividend, and it all comes down to what you do with the dividend. So if I follow the Aussie similar lists, and of course, look at each company. But yeah, I think I'd say for somebody starting out, they'd be fantastic.
Yeah, and the other thing that's really cool, like you said, a lot of times there's several companies in the Kings and Aristocrats list where their growth isn't there. Like even their dividend growth, like they might grow their dividend at 1%, 2% a year, which is not a lot, but it does say something about, let's just say Coca-Cola. I think it's 61 years. It's around that range. They've grown their dividend. My dog's sneezing. They've grown their dividend for 61 years, which means they've went through the .com bubble and have grown and paid their dividend. They went through the housing crash. They went through COVID-19. They went through so many different things. And through all of those things, they were not only able to keep paying their dividend, but they were also able to grow that dividend during those trying times. And I think that says a lot about the company, the ownership, and like the stability. Because the worst thing would get to is you buy into these companies that have super high yields, but they pay a dividend 1 year and then might suspend it for 2 years and stuff like that. If you're trying to build a income producing portfolio that you can retire off of, or even supplement your income in retirement, and you don't have companies that you can actually count on, how are you supposed to do that? Like you're supposed to, this year I know I'm going to make 52,000, but what if your biggest holding cuts their dividend or gets rid of their dividend? Then what do you do?
Yeah. And I mean, look, you look at a company like Coca-Cola, and I mean, worldwide, and man, do you see it here in Thailand. So they're just starting to take on the sugar-free element, more so here, but boy, it took them a long time.
Yeah.
It took them 30 years.
Yeah.
When Diet Cola was 50% of them, I know I used to be state sales manager of BIC, so I used to see the Australian Pacific guy selling Coke and watch the product range, and I'm very interested in ranging. And in Australia, there's a duopoly with regards to grocery predominantly, which is Coles and Woolworths. You don't have that so much there, but placement is everything. And I see here when I look into those refrigerators and the increased range. And what they've got, and I think they're only going to increase their market share here with no sugar, which is now they've got a sugar tax. So it's been finally, so it's been a thing. So big flood of no sugar drinks, but Coca-Cola is just so prominent.
Yeah,
and of course, like what was Buffett's dividend? Somebody wrote it in the
it's gross.
Group.
Yeah. That stuff, I don't even want to know that stuff, because I'm just like, man, that's ridiculous. He's making billions of dollars a year off of Coca-Cola dividends.
And he was standing there saying that he doesn't like dividends, And you think, well, wow, I'll take the check.
Hey, I'll give you my account number if you want to wire some funds.
Just wire it over there. It's no problem. I'll take it off your hand.
Yeah.
But look, I mean, I think that just the gentleman's question comes back to another thing, which is we're all guilty of this to some degree, and that is, kind of looking for the next big thing. I don't think you always have to find the next big thing. Sometimes the next big thing is right in front of your nose.
Yeah.
And we all try and look too far. And I think with Procter and Gamble and Johnson and Johnson and Coca-Cola and
Wal-Mart,
I mean, these are icons, USA icons. I once got kicked out of Walmart, by the way, in 1998 for having bare feet. I didn't, back then in Aussie it wasn't a thing. It was in the States, so I have that as a tick to my name.
There you go.
And she said, "Oh yeah, there, sir. Next time you might want to put on some footwear." I said, "Hey, I'm flying out of the place, sweetheart. Don't worry." But but yeah, Walmart. I mean, what an idea! It's a giant lump of predominant Chinese imports, but man, it works. And I even featured on South Park. I don't
That's
think
how you
made
it. When you're on South Park, you made it.
You made it.
Yeah.
Exactly. And that's why I knew I'd made it, because I got kicked out of there.
Yeah.
Well, not
there
kicked,
you go.
not kicked out. I was leaving anyway.
Yeah, there you go. Yeah, I'll escort myself out. Yeah. Okay.
Politely pointed out to me to put on shoes.
Yeah. Hey, I think that's one of the more modest reasons people have been kicked out of Walmart.
I would never do that now, by the way. If anybody's watching, I would never do that, but it was a long time ago, and forgive me.
Yeah, there you go. Yeah, hey, we all make mistakes. So, okay, so another question that Lewis had was, he said, what steps do you suggest people take to begin investing, and what would be the ideal account order to fund? So basically he wants to know, like, do you believe in getting an emergency fund and having that fully funded before you start paying off debt? Do you plan on, like, do you think, I mean, this one might be a little bit hard as far as the second part, because he's talking more about, like, funding a Roth IRA or a 401k before an HSA and stuff like that. So maybe you don't have to answer that one because you might not know all the different account types and stuff here. But for the first one, do you believe in the emergency fund before debt? Do you believe in emergency fund and debt before you invest, or how would you tackle that?
I would definitely pay off debt.
Mm-hmm.
Right. So like if you had credit card debt or anything like that, for sure, before I started investing. Personally, I don't do any emergency fund.
Okay.
And then now I know that would be against 90% of the group there, but I always consider if there was that big an emergency, I can get it in a few days anyway.
Yeah.
So for me, I'm always fully invested.
Okay.
And that's how but I've done it that way for years. So it was like what you've said before. I map out. It's a sizable amount of money now. So I map out when all those dividends are coming in and rents and all that sort of stuff. But even if I was starting out with zero, for me, I wouldn't bother with an emergency fund. But that's just my opinion. I know probably most people would disagree, but only because I can't see what would be that big an emergency.
Yeah. Yeah, that is true. Especially with, technically, I have 6 months worth of emergency expenses, but I keep 1 month in my savings account, or not my savings account, my checking account. So my expenses are only $1,400 a month. So I keep 1 month in there. So I always keep $1,400 in my checking. I don't let it go below that.
Yeah.
And then I keep 5 months over in so Fidelity, the cash holding in Fidelity.
That's a high interest, isn't it?
Yeah, it's a government money market that's offering 4.75. So the other 7,000 I just keep in there as cash, and then anything over that 7,000 is what I invest every month. And that cash that it's giving me, like the interest that it's generating, which is I don't know, like $30, $40 a month, that adds to the next month's investable cash. So that my cash that's sitting there is making me, and it's making me more than my dividends would, because my dividend yield on my portfolio is like 2.05%. So I'm technically making more on the money that's sitting in there than I am at, like, just in the dividend, obviously. Like, I'm getting capital appreciation from my holdings and stuff.
Now you see, you made a good point there, but you see, I'm thinking like an Aussie, and there is no Australian account like Fidelity.
Yeah.
Where you can just sit it in there and you're going to get 5.7 or whatever you said, 4.9. You can get that rate, but it's going to be tied up forever anyway. So from that perspective, you may as well own a REIT. Yeah. And so that's where I'm coming from.
Well, so the market, the Fidelity government money market that I'm in is just, so anytime I add cash, so when I would have a checking and a savings account, and I would figure out how much money I was going to send to my account for, May or June or whatever, it goes into, it's called FSAXX is the holding, but it's literally $1. It's $1 to $1. Like, it's not traded and it's not locked. Yeah. I can sell and transfer that at any point. And it's nothing on it. So I'm like, why would you not collect that 4.75% interest on just the cash you have sitting in there?
Yeah. So in saying it like that, I'd have 10 grand in a Thai bank account.
Yeah.
So from that perspective, I suppose I've similar covering. I'm not going to get the interest rate. Not going to get any interest, to be honest, for the likes. But it's an international thing and all of that, like your Fidelity. But I'm thinking from the questioner's point of view. I'm in Oz. I would say to him to follow a strategy similar to yourself.
Okay.
Him or her. So because I'd say if you can get 5% out of Fidelity, well, Yeah, look, that's fine. That's a REIT return anyway, or better, like you said.
Yeah.
So it's not really completely null and void like what it would be in an Aussie bank, which
Yeah.
is why I'm fully invested.
Even most people put their money in like a regular savings account or something here. Like the reason I switched mine is I had a money market account with my bank that was supposed, like, money markets are, typically supposed to give you more than a regular savings account. I was getting 0.1% interest.
Yeah.
And I was just like, what am I, like, I can get 4.75 over here just for keeping the cash in there. And it takes me literally a day to get the money from that cash position with Fidelity into my bank account if I need it. And I'm like, I've never, knock on wood, I've never had an emergency that big that I've needed to transfer that much money that quick. Because worst case scenario, something comes up, whether it's, I get a flat or whatever on my car, I just use my Fidelity credit card where I get 2% cash back. And then I just pay it off at the end of the month and I can transfer whatever I need out of it and cover it that way.
Exactly. And I mean, I guess that's probably where I'm coming from when I'm reading the group. You guys in general, Talking USA, have got so many more options, better options than, say, somebody like in Australia. I mean, another example is with your mortgages, where you can do massive fixed term mortgages. Okay, they might be expensive at the moment. You might want to not want to do one at the moment.
Yeah.
But to be able to do things like that, so you can't do that in Australia.
How do you guys do that?
Exist. So, well, what happens is they won't fix anything for longer than 3 years.
Oh, wow.
And if you fix for 3 years, you can't do a 30-year fixed rate and say I'll pay it off in 15 years. Just doesn't happen. You can pay it off in 15 years, but you're basically going to be on a floating rate, so variable rate. You could fix for 2 or 3, no 15, no 30 years.
Oh, wow, that's very interesting. Yeah, I refinanced
so
during COVID, and I got a 30-year fixed at 2.75% interest.
Oh, shit, mate. Fantastic.
Yeah, and everybody's like, are you going to pay it off early? I'm like, no, that's free money. I'm like, I'm not paying a dime
free
early.
Money, yeah.
Like, I will pay my regular mortgage for 30 years. I might even refinance 28 years from now, take out some cash of it, and then especially if the interest rates are, 3% or lower by then, which who knows if they will be, probably not. But by then, like, just, that's interest, or the inflation right now in the US is somewhere around like 5 to 6%. It's on the way down. But like, if I'm getting 2.75% interest on my mortgage, I'm basically borrowing that money for free.
Yeah, you're borrowing it for free. I mean, here I am at 62 and you're 28, right? I mortgage on investment property and I'm paying more than double what you are.
Yeah.
So I would say to you, and that is just how it is. I can't remortgage it out of the USA. So I would say to you, yeah, your strategy is great. Stick with your 2.7, and why would you pay it off?
Yeah.
What would be the point? That's all money you can put into great companies in the USA.
Yeah. Yeah. The extra, because when I first got my mortgage, it was 4.625%, 30-year fixed. And then, like I said, I started to get into finance a little bit during COVID. And that's what I learned, like, interest rates are going down. They had to lower them to 0, so they're really low for houses. Let me work on refinancing, stuff like that. And I used to be, I think my mortgage payment was like $879 a month. I put a lot of money down, but it was like $879 a month. So I was sending in the extra $121 a month in order to get it up to, I think even $1,000 is what I was paying.
Yeah,
I was putting the extra
yeah.
on principal. And then I started looking into it, and it's just like, there's people, I don't know if you're familiar with like Dave Ramsey here in the United States.
I know Dave Ramsey.
Yeah,
Yep.
so he's really big on, cash is king, pay off your debt and stuff like that. And then I actually saw a video, I think it was on the YouTube channel, Everything Money. And they did a calculation of the difference between the extra that you would put on principal on a low interest rate mortgage versus putting that into just like the S&P 500 and getting 8% a year for 30 years instead of paying off that mortgage early. And the difference was like $1.5 million just by not paying off your mortgage early. And like I get Dave Ramsey's approach is like the peace of mind of like the bank can't take your house if you own it. Like you still have to pay property taxes and stuff like that. But like in theory, that's just $800 that I would never have to spend again. Like I paid off my car for that reason, but my car is also a depreciating asset. So I paid off the car. The car is now mine. Like all those things. So it's a different way to look at it. But like I said, I'm pretty happy with the decision so far of just like, it'll stink, always having to pay a mortgage for, the next 28 years or whatever. But it's not the right or wrong decision at this point. It's opportunity cost. So,
yeah. Oh, it makes sense, Troy. I mean, I'm coming back to Buffett, but you guys probably don't appreciate, how many extra, the big benefits of being born in the USA, realistically, because, it is, a wonderful market. It is no matter what anybody says, it's a wonderful country in terms of opportunity. If you're smart enough, like you obviously are, to look into these things, because a lot of other people don't have that opportunity. And if you're there and you've got it, my God, utilize it.
Yeah, and I've tried to really do that in life for a while, because I was born in Pennsylvania. That's where all my family lives, and Pennsylvania is Northeast, cost a lot more money to live there. We moved to Oklahoma, which is where I live now. And Oklahoma's cost of living is so much cheaper than Pennsylvania. And I see people that are in Oklahoma, struggling to make ends meet and stuff like that. And I'm like, first of all, always remember you could have it worse. Somebody out there has it worse than you. So like, don't complain about anything really. And second of all, the people, like there's a lot of people that bash Oklahoma that live here. And like, I'm not born and raised here. So, but I do have pride here because like how quick it's growing, how cheap it is to live. And I'm just like, you guys don't understand a lot of people just get in their own way where they make things so much harder and they play the pity game and woe is me and stuff like that. I'm like, the government and corporations and all these people, they don't even know who you are. So a lot of people are just out here, oh, they want to hold me down, or I only have bad luck and stuff like that. I'm like, as bad as this sounds, nobody knows who you are. As an individual, nobody knows. Like the government doesn't make a new tax law to screw over Troy. That's not what happens. The government makes a tax law in general, and the smart and wealthy people are the ones that figure out, okay, I have no impact on whether this is or isn't law. All I know is I need to figure out how to adapt and move around it to better myself in the future.
Adapt, react, readapt.
So what you're saying about, what you guys have available over there and stuff like that, or even back in Australia, like it is one thing where especially if you're in the United States listening to this, like taking a step back and realize that we do have it better than most, and like just make the most of the opportunity you do have.
You certainly do. And, as I say, just purely driven by size and look, I've been fortunate to be there a couple of times, and it really is. Look, I know it has some shortcomings. Every place does, but it's still, I agree with Buffett. It's still a wonderful opportunity, and it's still one of the best places to ever be born, no doubt.
Yeah, I agree. Okay, so last question for you, and then I'll let you enjoy the rest of your night. So for those that don't know, Dave is in Thailand, and it is currently 9:37 p.m. for him. He is 12 hours ahead of me. So we'll let
I'm
you
enjoying a gin and tonic.
Yeah,
now,
there you go. Yeah, he's at a party, all kinds of stuff.
So I'll give you one other tip: don't drink in the mornings. Right?
Yeah. But for him, it's okay. Yeah. Okay. So last question for you. Do you have any advice for someone just getting started in dividend investing? And if your advice is to just get started, what else, like what other piece of advice do you have?
Yeah, well, you've summed up my piece of advice. So I would say, obviously, yes, just get started. Two would be to have a written strategy. Now, I reckon that's really important. It certainly worked for me. So go to the trouble of writing it down. Think about what you do when you go for a job interview or you start a business. All of these kind of things. Take it seriously. You might only have, maybe at the moment you've only got $100, but it doesn't matter. Write down the goals. What you're going to do, what you want your total outcome to be, and start planning it just as you would a business. And I would also add to all of that, besides getting started, and that is, and wouldn't be afraid to take those dividend direct credits, when you're young, because it's all about how you use them. And if your goal might be, for example, you're paying off a house, it might be to have the initial deposit for a house, whatever it is, write it all down, set your own strategy, set your own goals, and as you said before, Troy, don't make it unrealistic, make it achievable so that you can see your own progress. It's like your bodybuilding example. You have to start somewhere, and from there you can progress.
Yeah.
And I think they're the biggest things, in my opinion.
Yeah, and I like the idea. I think it was in Jeremy's interview that I was talking where him and his wife, the goal is to live off of dividends. He wants to retire his wife first, then he wants to be able to retire. He did a good job of writing down his end goals, and then he worked his way backwards and was like, okay, what would this look like 5 years before that goal exists? And what would this look like 10 years before that goal exists? And what would it look like on a month-to-month basis? And what would it look like today? And then if you do that, you can slowly start to give yourself a checklist. One, the checklist keeps you on target towards those goals. And two, it helps you build momentum, just like your compound interest in your account. Like, you can't make $1,000 a month in dividends before you make $100 a month. Like, you have to make $100 first. So when you make this checklist and all these goals, you can be like, okay, I know I'm on the path to the goal. And you might have this goal, like you might have this wrong, and then you might have this wrong. And there might be something that when you were writing your plan backwards, they seemed like they were closer than they are. And when you're in the moment of this wrong, you can say, okay, like, this is a good wrong, I get there, but like before I get to this one, I need to have another step somewhere in the middle. And then you can think of something else to add in there to make sure you're staying on track. So I really like that idea.
Yeah. No, I think that's really, really good what you've said there, and that's a good summary.
Yeah. Anyway, I super, super appreciate this interview. I'm glad you took time out of your night to speak with me. I've learned a lot. I hope the conversation was as fun for you as it was for me.
It's fantastic, Troy, and a terrific idea, mate. And do you have a channel yourself now? Or?
Yeah. So this will be going live. Let me see exactly when this goes.
So to everybody watching, like and subscribe, please, to Todd's channel.
Yeah. So your interview will go live on June 26th is when this will go live.
Okay, fantastic.
Yeah, so the channel is Dividend Obsession. You'll be on there. You'll be nice and famous. Make sure you guys, fantastic. Like I said, like Dave said, make sure you guys like and subscribe. And we will keep getting these interviews out. Dave, if you would, I'm hoping that this is my 4th or 5th interview I've recorded. I hope that they keep getting better and better. I'd love to have you back on, in future times. I'll have different questions, better interviews, all kinds of stuff. So, love to have you back on. Mate. This was great.
No, I really appreciate it. And hi to everybody out there. And as I said, like and subscribe, and hopefully we'll talk soon.
Thank you all so much for watching today's interview. If you're still here, I'm pretty sure it's law that you have to leave a like on the video and subscribe and ring the bell on the channel, so I'll let you do that. And if you did subscribe, you can expect 2 dividend-related videos each and every week with the goal of giving you some kind of knowledge to make you a better dividend investor. Lastly, if you'd like a chance to be on an episode of Dividend Discussion to tell your story, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But until next time, see you.